Are economists in the U.S. worry about inflation, a faster recovery in the U.S.? Could it mean the interest rate rise down the road?
That's a great question. That's probably at the center of the debate among all economists in the United States and the rest of the world, because there are two competing trends here. The bottled up opening of the U.S. economy, the very rapid rates of growth that we just talked about, are surely going to create bottlenecks and supply chain issues where prices will suddenly jump because everyone wants to buy the same things at the same time. And so we should expect a short-term burst of prices. But there's deflationary forces that have been acting on the U.S. and global economy for the last 10 years. From China, the trade of lower priced goods, and also the huge productivity increases that have gone into the service sector of the United States economy because of new technologies and the reorganization of how services are being produced. So those deflationary forces are really quite strong and will probably come back into play once the burst of spending subsides in about a year or so. So I personally believe that the rise in inflation will be severe. It'll be probably above 2.5–3% for about 6 months to a year. But then, as the Federal Reserve forecast suggests, it'll come back down to that 2% or even below in the 3 or 4 years out horizon. And that medium-term horizon is what the Fed cares about. So the likelihood of short-term interest rates or policy rates going up is very small. Right now, long-term interest rates have gone up tremendously by about a percentage point over the last 6 months or so. But you see already that has overshot. And we see that the last week or so, the long-term interest rates have come down from 1.77 to 1.65. So there's really a cap to the degree to which markets are anticipating the rise in inflation. Right now, inflation expectations are well anchored at 2.25%.